Dr. Singh's contribution is immense, especially with regard to economic reforms in India. So my presentation would predominantly focus on financial sector reforms. So I'll start my presentation and we'll see how it can talking about the financial sector reforms and economic transformation. This is a continuous process ushered in during Dr. Singh's regime. So before starting, I think we will just look at my flow of presentation. I would be introducing to the financial sector, the background of the financial sector, especially from the global context, and what was India's financial sector prior to 1990s, various segments of financial sectors, what reforms have been undertaken from 1999 till date. Most of the reforms have happened from 1990s till 2008, and recently a lot of reforms have also taken place. We'll also look at how did we fare. Most of this topic about how did we fare has already been covered by Professor Koti Reddy, and what is the way forward. So financial sector is actually what do you call firms and institutions that provide finance to retail and commercial customers. So it involves banking sector. In banking sector, we have retail banking, investment banks, non-banking financial corporations. We also have insurance sector. We have an insurance. We have general insurance, life insurance, health insurance, a lot of these things. Then you have the equity market. This is predominantly the stock market, which we are talking about. And you have the fixed income securities, the bond market. It's also referred to as the debt market. Then you have the forex markets. These are predominantly exchange markets and clearing houses. In economics, usually there is this simple two-sector model. So there are firms, there are households, and in a closed economy, households give all the factors of production. Firms take the factors of production and produce goods and services. In a four-sector model, you have a lot of other stuff, external and also government. But what joins to all this economy is something called money. And this money is actually the joining is feasible only through a financial sector. So this financial sector in any country, it acts as an intermediary. So it takes one's excess savings and it will give it to people who need those funds. They're also called borrowers. The borrowers can be retail borrowers. They can be corporations. They can be big business. They can be small business. So anyone can borrow it. It will actually acting as a hedge, kind of barrier, bridge. So in many countries, banking usually, whenever we talk about financial sector, usually banking comes into the scenario. They have taken center stage among financial intermediaries. So when the Great Recession happened in Depression 1929, these banks as safe haven investment, they actually collapsed, and it has led to a shrink in credit availability. This is the context when banks became very, very inward. Regulation came, it controlled a lot of cost of deposits. It also controlled it controlled that because it wanted to reduce the inherent risks. So to give a context, during 29, the Great Depression, a lot of banks fell. There is no money availability. There was a lot of credit mismatch. So in order to protect the depositors from bank failures, a lot of assurance was given to depositors. And because of that, we want to ensure supply of funds. However, in India, neither of this consequence, like for example, banks defaulting is of any consequence. The reason is this is the context for India's financial sector in 1990, before 1991. We had a concept called monetization of budget deficits. Okay, and the prevalence of directed credit. So we'll discuss monetization of budget deficit and prevalence of directed credit. So in a short while, in short, it is actually telling that the government is the major borrower for a reason, and credit was directed by the government. So it's like, what Dr. Y.V. Reddy calls it as a household which was managed. It's the one which is managing all the things. So there is a possibility of runoff is almost like zero. because of nationalization. Most of the banks in India were 1969 and all, they were nationalized. So because of nationalization, you hardly have any probability of runoff or banks defaulting. This is what has happened. However, as the speaker before me has mentioned, we were actually following a planned economic model. So the Mahalanobis model, it's called a mixed economy, planned economic model. These characteristics have also flowed through the financial sector in India. So mostly the financial sector in India prior to 1991 has taken over the legacy of the planned economy or the Mahalanobis model. So whatever financial sector we had, it essentially catered to the needs of the planned development mixed economy. So here, as I discussed, government was the predominant player. So it is the one who could take majority of the loans. There was nothing like fiscal neutrality. So it was all about fiscal activism. So very active, the government was very active in the financial market. So we'll go one by one. We'll look at the banking sector, what has happened. So banking sector was heavily regularized in 1990s, before 1990s. So there were a lot of procedures, guidelines about how banks have to operate. There was nothing like a concept of a private bank. We had very high opaque accounting norms. There was nothing. The principal focus of inspection and supervision was ensuring that just the protocol was followed. And there was something most importantly called the administered interest rates. In the earlier slide, we were talking about monetization of debt. Just because government needs money, it has to monetize the debt. It has to monetize the debt. The easiest way is that it had to administer the interest rates. So they were like kind of fixed borrowing and lending rates. And a completely fixed set of interest rates. Very less instruments were there. And even in the less instrument, there was a very fixed set of interest rate and slowly moving exchange rate for a large economy. The other characteristic was lending was usually directed toward priority sector. The priority sector usually has agriculture, small scale industries, and specified weaker borrowers. And the people who needed, especially the big business, industrialization, they hardly had any money. You also had something called compartmentalization of activities for intermediaries. This has resulted in low efficiency and productivity. So in economics, we call it something called a market equilibrium, or it's called a market. Free market will actually clear off the demand and supply. So, but however, because there's a huge mismatch, government is the largest player. There was very low availability of credit to the private sector. Okay, there was very tight separation between banks and non-banks. Usually, banks had high liquidity, but they had problem with lending. Non-banks can lend to a lot of people. They have wider latitude, but can borrow only from wholesale people. So essentially, the banking process is predominantly a focus of regulation and supervision. Risk credit, they hardly had any attention from the regulator. They were very high economic costs. But what we had is we had hardly any blowouts. That means there are no bank runoffs. Then you have something called a debt market, or they call as a bond market. So here, government is the major player. As we mentioned in the earlier slides, there is something called monetization of debt. So whenever government wanted money, it had to sell the securities and it monetized that. Predominance of government securities in the fixed income security markets, and it is used only for the government. Most financial intermediaries were mandated to invest sizable portion of their funds, such as securities, to finance high government borrowings. The problem with government borrowing is that most of the government borrowing has into long-term big projects, huge projects, which have very huge gestation period. And because of that, there is something called an administered interest rates. To give a perspective, the interest rates were just 4.6% at that point of time, fixed by the government, not by the market. Because of that, it has highly been skewed, regulated market. Then you have the security markets, the stock market or the equity markets. New equities issued governed by them, and they're governed by very complex rules, regulations, restrictions. There is hardly any transparency at that point of time, and there is no depth in the secondary market. Predominantly, whatever has happening was happening only in the primary market, where the IPOs were happening. That sets, and there is hardly anything called a secondary market where people can dig in, keep a lot of their savings. Then you have forex markets. Sir has actually mentioned most of this. Then you have money markets. Here, central banks moved its instruments like interest rates to control the monetary aggregates. So monetary aggregates are nothing but the total supply of money in the economy. The total supply of the money in the economy was controlled by the central bank through the government, because government was in administering the interest rates, and it is controlling the monetary aggregates. In fact, this is what Dr. Y.V. Reddy calls it as a de facto family joint balance sheet. So there's a government, there's central bank, and there are commercial banks. So there's a head of the family, and he is managing most of the funds, taking from one pocket to keeping another pocket. And in the end, it is all staying in the house. Nothing is going into the free market. So this is what has been characterized. This characteristics has restricted the free flow of credit. The banking sector was highly regulated. There was hardly anything for the industries, companies, corporates to tap in from the security markets, debt markets. Government usually is the biggest player, so it is highly impossible. And there was nothing like there were no private banks, there were no private capital flowing from outside FDI and all. So 1990s are the one. There were a lot of reforms. These reforms were actually from the World Bank kind of liberalization mandate. However, they started as a big bang in 1990s, but it was a continuous process. So Dr. Singh was instrumental along with Mr. P.V. Narasimha Rao in ushering this. But as Montek Singh Ahluwalia writes, during the 25 years of economic reforms, there was some kind of reforms which are started prior to 1990s also, but they were very, very minimal. They were just starting. But when Dr. Singh came, when he was the finance minister, it were big bang reforms. So these reforms, though they are big bang, they were also characterized by conscious gradualism. So India is still a kind of mixed economy. So they were very conscious. They were very gradual. They have to, because there are two objectives which have to be ensured. One, you need to have growth by doing these reforms, and second, there is also you need to have stability, because most of the Indians, they used to save whatever they have in the banks. So the first part of reforms, they are the liberalization toolkit reforms. I'll call them 1990s. I have not segregated them 1990s, 2004, 2014, 24. But these are reforms which have been long drawn. The first set of reforms which have happened mostly in banking sector, the banking sector reforms and monetary policy reforms might overlap once a while, but that's how it is. The first one, what Rakesh Mohan, former Deputy Governor of RBI, says is that prudential measures. So what did they do? They have introduced best practices. These started then, but in fact they have been ushered in 2008. A lot of reforms came. International best practices. You have Basel norms 1, 2. Then you have also new Basel norms. You have new accounting standards. You have something called something called capital adequacy ratio. This ensures that the banks hardly fail. You have new accounting standards. Then you have risk assessment strengthening. Now, initially, the banks hardly had any weight ratios, but now because of the ongoing reforms, slowly a lot of risk weights have been brought up. Then you had something called a market to market principle. So this ensures the asset quality of the bank is measured in a right way. Then you have competing reforms. So operational autonomy has been given to the public sector banks. They also undertook diversification. Now they said that equity can be 49%. Earlier, almost government used to have all control. Slowly, they have been diversified. Because of diversifying the equity, banks have been pumped up with a lot of money. That money had been used to improve the activities of the bank, to improve technology, improve credit expansion. Private sector banks came into the picture, foreign banks came into the picture, a lot of FDI came into this. Then not just um, um, equity diversification. Because of this, there is also something called product diversification. Earlier, banks only used to take loans and take money as deposits and give loans. But because of new economic reforms, banks have now started to offer a whole gambit of um, um, portfolio of basket of goods, services. So you can have insurances. Now you have term deposits. A lot of these things are coming into the picture by banks. Banks are also acting as intermediaries now for currencies, a lot of this stuff. And you also have something called market forces. So initially, when it was administered, or maybe you can, when it is controlled by the government wanted liquidity as a first preference, stability as a first preference. So it wanted, there were a lot of high reserve ratios. So the government's, this was actually introduced by the Nasiman Committee. Statutory liquidity ratio used to be close to 40%. Okay, then it has now new economic reforms ensured it has come down by 25%. It is even more. Then you have CRR, cash reserve ratio. So the proportion of money, cash, which banks has to keep with themselves first used to be 25%. Now it has brought down to 10. Because of this, banks now have additional leeway. So the additional leeway could be they can give credit. Now, there is also something called market determined pricing for government securities. Earlier, as I mentioned, government used to determine whenever it has deficit, it has to print the treasury bills. Predominantly, these treasury bills are 91-day treasury bills. It has to take it into the market, make sure the banks bought it, and it was bought at only 4.6 or 4.8% of interest rate. But now, because of the new economic reforms, government securities are also determined by the market. Then you had this interest rate, which has been administered. Now it has been diversified, disbanded. Then there is something called a pure interbank call money market. The call money market is a very short-term money market. Because of the short-term money market, a lot of liquidity is adjusted, and there is enough liquidity for the banks. And from bank rates, now you have something called reverse repo rate and repo rate for short-term liquidity. And this is an auction-based repo and reverse repo. Earlier, it was determined by the government. And the government also bought a new thing called LAF. So it's called the Liquidity Adjustment Facility. And in the Liquidity Adjustment Facility, there is something called a repo, reverse repo, and in between there is something called a corridor. The corridor is the one which will determine the interest rates. So now, then you also bought institutional legal measures. There were debt recovery tribunals, credit information bureaus. There was this establishment of Credit Clearing Corporation of India. So this facilitate payments for the money market. Then you have something called supervisory measures. The government said that now we'll go for international ratings. Now there is something called CAMELS. This is a supervisory ratings. It's also risk-based supervision. In the CAMEL, there are almost like 6 parameters. What are your assets will be there? What kind of ratios are you following? CAR, how much of capital adequacy ratio do you have? And when in the CAMEL, the rating is from 1 to 5. If 1 is, it is very, very good, and 5, it is not good. And these are new age reforms. The new age reforms did not start from 1990s. It have slowly picked up after late 2000s, and now it is picking up even more. Technology reforms, Infinet, RTG, RTGS. Then you have SWIFT. This have actually ensured greater transfer of resources to the money market. Then you have the security markets, the debt markets. Now the institutional measure is like there was now an auction system for price discovery. Then you have something called, it's slowly phasing out of the automatic monetization. Now government cannot just say, I have a debt, I'll issue treasury bills. And LAF tool as interest management and signaling for the overnight money market. Then you have MSS, marginal standing facility. The marginal standing facility ensured there are more instruments for RBI in managing the liquidity. Earlier, there were only bank rates. Now MSS came 15 years, 20 years ago. And in this MSS, what happened is that there are new instruments. So greater money market instruments have come into the picture. So now we have, earlier there was only 91-day treasury bill. Now you have a lot of treasury bills, lot of bonds which have short-term maturity, very long-term maturity, bonds which have very less. Then you have zero coupon bonds, capital index bonds, and the government has also, in the reform process, they have opened up foreign institutional investors to invest in government securities. Then the third one, which is equally important in the financial sector, is exchange rate market reforms. So as Sir has mentioned before, there were two trenches of devaluation happened. 9% and 10 or 11%, and it happens in 2 to 3 days. So there's a small antidote which has happened. I think I can share this. So when the first devaluation happened, there was a lot of pressure on the government. The Prime Minister, Honorable P.V. Narasimha Rao, had a lot of pressure from his cabinet ministers. They all went and said, no, you bought your new finance minister, who's not a politician, he's an academician, and he has devalued the currency by almost 9%. By this time, the decision was taken to devalue the currency in next 10%. And there was a huge pressure on Dr. Singh to say no to the next devaluation, this next trench of devaluation. So very reluctantly, Dr. Singh agreed for this not to do the second devaluation. But thank God there was no technology at that point of time. So by the time the phone call, because the central bank, Reserve Bank of India is in Bombay and the government stays in Delhi. And by the time there were trunk calls. So the trunk call has been booked and the information has been passed to central bank in Bombay. They have already done the second devaluation. Now nothing could have happened. So, the second devaluation is because thank God there was no technology at that point of time. And there was, we moved from a single currency fixed basket to market-based floating regime. So we used to peg fixed currency, then it went to a basket. From basket, we have slowly moved to a market-based floating regime. Then based on Tarapur committee recommendations, initially India opened up to current account convertibility. It has been now full convertibility at the current account. Capital account convertibility, only partial. Your in NRIs and all can do that. Then you have this very strict FARA regulation to FEMA, which is more of management, from regulation to management. This happened in 1999. Now RBI has also ensured slowly authorized dealers to release Forex. So now you have the swap markets, a lot of rupee currency, foreign markets and all this. Then there are something called monetary policy reforms. Monetary policy reforms, there's this twin objective of maintaining price stability and growth. Earlier, it was only monetary aggregates. From monetary aggregates, that means money supply. From money supply, monetary policy reforms went to multiple indicatory approach as a target. Multiple instruments are also being ensured to transmit the liquidity rather than just bank rates, repo rates. Now you have a lot of open market operations, securitization. And in fact, this has started in 2000s. There was increased linkages between money, security, and forest markets. And the last but not the least, along with the financial sector, you also need to mention fiscal policy, because government is one of the biggest player in the finances. Earlier, deficits were not mentioned. They were not reported. The new FRBM Act, which came very late, but before the new FRBM Act came into the picture, it was Dr. Singh in his first economic survey who brought this concept of fiscal deficit into the public. So he bought it, and from being financed to 91-day T-bills, it has moved a way to be financed by the market. Now the government also have to go to the market. And these are long drawn reforms. And when we are drawing about these reforms, I'll talk a little bit about these new age banking sector reforms. The new age banking sector reforms, which have been ushered by the last 10 years, is predominantly concentrated on digitalization, which has actually increased credit outreach. You have this new Jan Dhan Yojana. There was this insolvency and bankruptcy code. Then you have DBT, direct benefit transfer. You also have this UPI, which has actually ushered in new techniques, new more liquidity in the market. Now, how did we fare? Now, earlier we were in the middle growth rate sector. So we were growing only at 4% GDP growth rate. We have moved to 8.5 in the early and late middle of 2000. Then we have slowed down to 7. Now there is a little slowdown, but our average growth rate in these last 30 odd years is somewhere around 6.5 to 7%, which is huge. With all our shackles, with all our handicaps, this is what it is. And over these years, from 320 billion in 1990, our GDP grew through almost like close to 4 trillion. We are right now around 3.7 or 3.9 trillion. So this way we are nearing to 4 trillion with a target of 5 trillion in mind. Same with inflation, because the financial sector also, because money market is one of the one. One important thing is that we used to have persistent near double-digit inflation, which has come down to manageable inflation levels. You looked at investments, you have a lot of FIIs, you have a lot of FPIs, from 2014 to 24, the gross FDI which we have is close to $1 trillion, which is huge. And on a quarterly basis, we are having I think on a year, we are having somewhere around 40 billion FDIs, which is huge. Then you have also DPIs, domestic portfolio investors have also increased. In fact, I was looking at the stock market data, people where they are saving. It used to be somewhere around close to just 1% Indians used to invest in the stock markets, 1.2, 1.4. From there, we are close to 5%. So there's a lot of growth in mutual funds. There are a lot of private mutual funds which came into the picture. Then trade, which sir has already discussed at length. From almost like very less exports to we are close to 400 billion exports. It's not just the magnitude, it's also the basket has improved drastically. So if you go to IMF and look at the trade basket, predominantly we used to export kind of raw materials. Now our primary export is petroleum, refined petroleum. India is mind that India is the net importer of petrol, but it is also the highest, the largest exporter of refined petroleum. In fact, we are the 5th largest exporter of refined petroleum in the world as of now. However, one thing which did not drastically improve in the trade is that our trade as a proportion of global trade is still remain very, very low. Banking sector reforms, banks have reached drastically, there is this last mile connectivity. You need to give the recent governments also credit because of Jan Dhan, a lot of expansion of bank branches. Now there are close to lakhs of bank branches. Most of the banks have very sound asset quality. There are better capital adequacy and other ratios. There is also this huge credit offtake. So earlier, take a loan, credit is very difficult. Now there is good credit offtake. Then you have the financial markets. India's stock market market capitalization used to be very, very minimal. From there, we are many trillions of market capitalization. Now we are one of the largest, fastest growing stock market. We should also give credit on this. Our stock markets are the one which have been resilient in a lot of crisis periods, turbulence. Even during the 1997 East Asian crisis or the 2008 global financial crisis or the COVID crisis, there was hit, but we were resilient. Now what is the way forward? The way forward, there are these new age reforms. They said that we need new reforms. The new reforms, they from 2005 to 11, the expert committee gave a blueprint of financial policy reforms. This is predominantly has to be focused on the legislative landscape, establishment of financial sector reforms commission. It is called the Indian Financial Code, which still has to come up. It need to transform the financial laws, regulatory functions, especially from licensing we have come to regulating. So when regulating, we need to still regulatory Raj. We are still in the regulatory Raj. It has a lot of slowdown, but still we need to come to a free market. Now, there is also something called a full convertibility of currency, which makes more the foreign markets, the debt markets, the bond markets more deep, more wide, more liquid. Then, insurance reforms are still very low, very nascent. Because of that, insurance penetration is in India still not on par with a lot of developed countries. And monetary policy reforms have to, because even now RBI is somewhere chipping in, central bank. So fiscal deficits have definitely fallen down from almost like 8% close to fiscal deficit. We have now, because of the new FRBM Act, we have come to close to 5. It was below 5 for a long period of time. Then after COVID, because a lot of money has to be pumped, liquidity. Then because of that, now we are again close to 5. So this is what predominantly is the reforms which have been undertaken by Dr. Singh, and from Dr. Singh, it has been also taken over. In fact, you know, it was very bold at that point of time. India had a string of kind of outlook, or maybe kind of way towards an economy. It was always focused towards about a mixed kind of planned economy. From planned economy, from we turned a lot of kind of socialist kind of economy in between in 1980s and in a decade. And by the way, mind you, Dr. Singh was also a part of the earlier regimes as finance secretary, as RBI governor, and all of these things. So he was there, and from there, seeing that and ushering in these new age reforms, he was a gentle giant, very slow, very calm, and full of always thoughts. And he always looked forward for the country. It's an honor that we have been led by such great personalities. The economy, the Indian middle class owes a lot of these things. Indian corporates owe a lot of their spread, their profits, and a lot of these things, Dr. Singh. So this is India's financial sector in a nutshell. I hope I did not exceed my time limit. I thank the organizers for giving me this opportunity. Thank you.